Welcome everyone to the first edition of the Shaw and Partners monthly video update for 2026. Now, at the risk of being a little late, Happy New Year. I hope you all had a great summer, and my thoughts go out to any of you who may have been badly affected by that weather bomb that hit in January. Now, the year has started with a flurry, lots of activity and movement in financial markets, and I'm sure a fascinating year ahead for us. Now, to kick off, we can quickly wrap up the share market movements over the December-January period. The US Dow Jones Index rallied both in December and January, made small gains. The S&P 500, the broader market benchmark, also made gains, just under 1.4% in January. The Nasdaq Index, it lost some ground in December, but recovered quite nicely over January. Now, we can also look at the annual returns for 2025, and they do make for pleasing reading. The S&P 500 gained over 16%, while the Nasdaq gained just over 20%. So generally, a pretty good year to be invested in US shares, US equities. The Aussie share market, it posted gains in both months, finishing the year having gained just under 7% in Aussie dollar terms, almost 12% when you look at it from a New Zealand dollar viewpoint. The NZX 50, though, despite a small gain in December, fell just under 1% in January. Now, the Magnificent Seven always tends to gather plenty of attention. At a high level, an index of the Mag 7 gained in both December and January. And over 2025, that Mag 7 index lifted 24.9%, so still a very important part of the overall share market return. And looking at a global index, we saw a strong gain in January in US dollar terms, up almost 3%, and that followed a 0.94% gain in December. So again, very pleasing. Now, looking across other asset classes, and there are very important stories that need to be told, and it's useful in this theme to consider interest rates and currencies at the same time. Now, the story of 2025 on a global level was very much led by central banks, and there was this ongoing drama playing out at the US Federal Reserve with massive political pressure being applied to the incumbent chair, that's Jerome Powell, primarily to lower the Fed funds rate and assist the whole of the US yield curve to move lower. And we saw President Trump and Scott Bessent being quite vocal about wanting the Fed funds rate and the US 10-year Treasury rate a lot lower. The thing is, US monetary policy has what we call a dual mandate. So the Federal Reserve must manage both employment and inflation. And it was a year that brought with it a considerable number of shocks or external events that monetary policy had to react to. So it was actually a really hard year to manage monetary policy for the Fed. Amongst other things, you saw the introduction of the highest tariffs in the US for many decades. You saw the longest government shutdown in US history, federal job cuts under DOGE, the increasing penetration of AI-related changes to the labour market, and of course, the substantial changes to the immigration dynamics into the US. This all created considerable uncertainty about the actual state of the US labour market. So after holding the Fed funds rate steady for much of the year, conditions were seen to be appropriate for the Fed to start easing the policy rate, and we saw 25 basis point moves lower over the last quarter of the year. The thing is, inflation, though, is proving to be a bit sticky, and at the most recent Fed meeting in January, that rate was held steady. Now, policy rates were also lowered in other jurisdictions around the world as inflation globally was generally brought under control. Now, the lowering of the Fed funds rate at the end of the year followed what had been a substantial weakening of the US dollar. So a US dollar index fell around 10% over the course of the year. Now, as the year closed out, there was plenty of discussion around the role of the US dollar as the global reserve currency, and this discussion was given the title of the dollar debasement trade. Now, it leads quite nicely into the story of precious metals. We saw a huge surge in interest in gold, and the price went up really sharply at the close of the year, as did silver. And both of these metals seen as being a sort of store of value, a hedge against inflation and uncertainty. But right at the end of January, the parabolic rise in silver, that sharp turn up in gold, spectacularly reversed. And a possible catalyst was the nomination of a new chair for the Fed Reserve. So Kevin Warsh has been nominated to replace Jerome Powell when his term ends later this year. Now, while markets had been focusing on the ongoing tension between the president and Jerome Powell, it was assumed the nominee would be overtly dovish. However, Warsh has been seen historically as an inflation hawk. This created some doubt about the validity of the dollar debasement argument, given the stickiness of inflation and the implications of that for future Fed fund rate moves. Now, the New Zealand dollar had been weaker over the second half of 2025, and there was concerns about the local economy, the lowering of our OCR, but that has turned around over December and January, and the New Zealand dollar has rallied from about 56 cents against the US to over 60 cents. Now, these are all ongoing stories and themes, and I think will provide a fascinating macroeconomic backdrop for investing over 2026. And I suppose we can't really talk about financial markets over the last couple of months without mentioning the geopolitical and trade issues in the background as well, with the Trump administration making a military intervention in Venezuela and the strident demands for control over Greenland, so saber-rattling and destabilizing current global and military alliances. So what about the outlook for 2026 though? Well, AI spending and penetration into general business will be one of the key themes playing out. And there have been some concern over the sheer volume of spending, particularly by what we call the hyperscalers, those Mag 7 companies making massive capital investments into the AI space. But look, this sheer volume of spend creates its own momentum. And 2026 could also be the year that we see non-tech, ordinary service and industrial companies really leveraging AI, which could generate improved earnings, albeit very likely at the cost of employees. US growth appears robust, and it looks like the US will actually lead the world's advanced economies in the growth stakes, and at the same time, expectations for earning growth are still pretty healthy. That all creates a positive tailwind for share markets, notwithstanding that current valuations do suggest that some of those tailwinds are already reflected in share market levels. So let's spin the spotlight back to New Zealand. We've got an election this year. We've got a new central bank governor as well. And those flickers of growth that we were acknowledging back in October and November appear to have blossomed. And so very pleasingly, we've had economic data released over December and January that have indicated that the domestic economy is recovering, and 2026 should finally see that economic rebound that we were collectively holding our breath for as we trundled into 25 has finally appeared. It's a bit of a fragile recovery at the moment though, but consumer confidence has continued to improve. Business confidence is at healthy levels. Economic activity does seem to be lifting. Building consents are improving, and tourism continues to make pleasing gains. The big question is whether we can grow the economy without sparking a troublesome lift in inflation. And that could very well be the real challenge in 2026 for the new Reserve Bank Governor, Anna Bremen. So it all adds up to a profoundly dynamic macroeconomic backdrop. And our role is to react to that from an investment perspective. And that is still very much the case. I mean, last year, I said we had shifted our investment view a little bit. We were a little less enthusiastic about investing in local fixed interest, so we've initiated an underweight exposure there, and we're still slightly favouring growth assets, and we're getting a little bit more interested in the New Zealand share market. Now, there doesn't seem to be any respite from the potential for geopolitical and trade shocks, and our response to that is it really argues for a well-diversified approach to portfolio construction. Financial markets are continuing to deliver attractive returns, and as the new year continues to unfold, if you'd like some guidance in how to participate in financial markets consistent with your investment objectives and risk tolerances, why don't you get in touch with us and we can help you navigate what are now quite challenging markets and bring our decades of experience to assist you in providing for your financial future. But if you do want to know a little more, you can look us up on shoreandpartners.co.nz or on Facebook or LinkedIn. We'd love to hear from you.